Gold's at
Sure.
4,000 bucks. Okay. Made a low in 2015 where 1,050. So we're fourfold. Okay. If you go back and look at the two prior bull markets, 76 bear low to 1980 high, 2001 to 2011, both were eightfold moves, bear low to bull high. So on a ratio scale, we're only halfway to what those two bull markets already did. And yet we've got conditions out there that are fuming and starting that could drive gold well past an eightfold move. This spread is saying, don't think gold is overvalued. It's just beginning. I'm not saying you're going to stop there. I'm just saying when you get to 8,000, at least you have matched the peak at 1920 in 2011 and the peak at 850 in 1980, which were the end of eightfold dimension moves over different spans of time, but same dimension on a ratio scale. Match that, you got to go to 8,500.
Michael
Silver could
Oliver
go
says
to,
gold at
I'm guessing,
$4,000
150
is
to
only halfway
$200
through
in
its
6 months.
potential, with conditions pointing to $8,000 to $8,500, while silver could surge to $150 to $200 in 6 months. He says gold miners are undervalued and set to outperform gold, while silver's spread signals a major breakout, potentially hitting $150 to $200 in 6 months. Historical patterns and momentum suggest this is the start of a powerful move, not the end.
Yeah, they're vastly, the miners are the better place to be. They're vastly undervalued. If I ran a spread chart, which we've done even in this report, I think, of the miners versus gold, yeah, go to another page. This will show, keep going. This will show you gold miners. Keep going. One more page.
There we go.
This is the XAU index. It's the Philadelphia Gold and Silver Miners Index. It goes back to the 1980s, this index does. That's why we used it to measure against the S&P here. Just like gold, it had a collapse in relative performance that ended in 2015 on this spread. And sure enough, since that price low in XAU, it also made a spread low down there just above 2%. And you had a big rally. Then you had another pullback to that 2% zone, another big rally, another sell off down toward the 2% zone. And now look what's going on. You have a 3 point, now a 4 point trend line that you hit in September. October was a mild pullback from that line. November is now upticking. Now, I don't know if you're going to break out this month. You're just below the breakout level. But notice the behavior at those two prior peaks. When you hit that line, you imploded. This time we had a down month in October on the spread off of that line, meaning that line is now validated as a structure, and you're upticking instead of continuing down. You close that spread out around, actually, our number is 4.45%. If you close a month there, the gold miners are doing what gold is saying as well. We're now going to outperform the stock market. And in fact, if you smack yourself in the face and realize what you're looking at here, at this level at around 4.5%, go back and look at the action of the last 10 years. Most of the lows were 2.5 to 2%, meaning miners are about double their performance of the S&P when you measure against those lows. For instance, if you went in late 2015 and bought miners and sold the S&P, you're making money, you doubled your money. We went from 2 something to 4 something. Okay. Similar with the other lows. Anyway, this is another asset class shift signal. And the miners, by the way, if you run this same spread chart against gold itself, they are very dirt cheap historically. Let me chatter on about this. If you take the XAU and go back to the 1980s, 1990s, 2000, up through about 2008, so about 30 years, this spread, which is now just below 4.5%, was living in a range from 17.5% to 30%
Wow.
of the price of an ounce of gold. Okay. Now it's at 4.4% of the price of gold. No, excuse me, on this chart. But actually, versus gold, it's 7% right now, 7.5 area, XAU into gold. You get that beast above about 8%. And you ever see XAU rise to a level that it's getting credibly out above 8%, divided into an ounce of gold, and you have a 10-year base there that is breaking out, that spread could double or triple just to go to resistance. the next resistance on the historical spread chart. I think the miners are about to outperform gold in an astounding way over the next year or two. So if I were investing in monetary metals, which is what I'm doing, my focus is primarily on the miners. Yes, I'm watching gold. It's very important. It's the mama, but the miners will outperform it. And two, silver. If we go back a couple more pages, we can look at that silver chart. Well, no, another page.
One more.
These are the spread charts now. Now
Okay.
this one's different because this is monthly going back to 2020. The top chart, it measures an ounce to December silver right now is the contract we're looking at, and December gold. We rotate to the active front month constantly on this process. Anyway, we can see that back in 2020, when we had that huge surge in silver and gold shot up 40%, silver doubled in price. That was during that COVID period, and when the Fed came in and printed a lot. Okay. The performance of silver beat gold handily. It surged big from like 0.9% to 1.5%. That's like buying a stock at 90 and having to go to 150. Okay, same dimension. But over the years, since gold went into that range, after hitting 2000, price of 2000 in the year 2020, when this spread basically peaked, where silver was beating gold, during that period of sideways in gold, the silver and the miners tended to erode more. Instead of going sideways, they tended.
He says key market triggers are about to be crossed, signaling that a major move in monetary metals is just beginning, not ending. Based on historical patterns, the next 6 months could see dramatic price action, especially as other assets decline and T-bonds show illiquidity.
Therefore, on this spread chart, you see a decline. And the red line on the top chart, the spread chart, shows 1, 2, 3 hits on the line. That third arrow was September. October had a mild pullback off of that 3-point trend line. Mild. It didn't drop sharply as it did in prior hits on that line. This month, you're out above it. So just on the spread chart, you're breaking a 4-year-old trend line. Now, there's also a flat ceiling. This is probably even more important. It's at 1.31%. Now, write that down if you want to. Divide December silver into Dec gold and express it as a percent. Right now, it's a 1.23 or 24 right now. Okay. You get over 1.31 and you blow through that multi-year ceiling as well. So the spread at that point says, it's it. I'm gone. I'm going to beat gold now. I'm going to surge against gold. What's below it is our momentum chart of the spread. We like momentum because it usually leads price. In this case, spread chart is price versus price. Okay, the momentum chart measures that spread action relative to a 10-month average of the spread, and it creates this oscillator. And you can see the red line on that chart, 2 highs back in 22, 24, and also a low in 2020, all lined up perfectly, a perfect ceiling. You're pressing at it for the last couple months. You close out this month about 1.246% to get precise. Divide D silver into D gold, express as a percent. This spread blows out through a massive base. It says, I'm on my way. Again, this is a spread situation like the gold S&P that says, I'm just beginning. I'm not ending something. I'm just starting something. The last time silver had a spread breakout like this, where once the spread broke out, you gushed to the upside, silver beating gold, was in 1979 and 2010 to 11. That's when silver quintupled in price in 5 months in 79. Summer 79 to the peak of the early 1980. It quintupled in 5 months. And in 2010-11, between the month it broke out and hitting its high in April 2011, it went up double and a half in 7 months. You break this spread out and we think, no, this is not the end of something starting, but it's a major explosion in silver versus gold. We're arguing that it's highly likely based on some other major factors. We can talk about them if you want. Just historical price ranges of silver that are highly distorted by monetary degradation in terms of where it should be. Silver could go to, I'm guessing, $150 to $200 in 6 months. Has it happened before? Yes. Triggers that I'm looking at, you're basically, one of them is already at a pull level where you've already pulled the trigger. All you got to do is close the month where you are right now, and that trigger gets pulled. We can look at that first if you want later. And then the other one, there's another trigger I'm looking at that is close. And when these triggers break, it's telling us something is about to begin, not that the monetary metals, which seem to be have had an explosive move, which they really haven't. I can explain that too. Uh, it's just beginning. And it's not just a function of them going up, it's a function of another asset category going down. Because so far lately, you'll notice, except for January through April, when the stock market imploded 20%, gold shot up during that time.
Hmm.
Total opposite to what the assumptions are. So did silver during that time. So you can look at both charts and sort of say, well, they're sort of all going up together, and they're really not when you measure them versus each other. And there's a signal structure that's about to be crossed that says that it just began. Something big just began. And it's at that point that my working assumption based on historical analysis is that in the 6 months following the trigger pulls that I'm going to show you, you'll see dramatic net price movements, especially in the monetary metals. Something that'll take your breath away. Not normal.
Michael Oliver says the gold versus S&P spread has just broken out of an 11-year base, signaling a major shift of money from stocks into monetary metals. This breakout suggests gold's rally is just beginning, not ending, with strong potential for continued price and performance gains.
Chart. So the first one is the gold versus S&P.
All right, and so Michael, I'm now bringing up here your latest report that you've done there at Momentum Structural Analysis. So as you want to talk to any of these charts, just tell me which chart, and I'll pull it up on the report.
Sure. Well, this first one is the gold versus S&P 500 spread chart, meaning the relative performance action of gold measured against the S&P. And what we do here is we simply take the closing price each month of the front month active gold contract. Right now, that's December gold, and divide it into the price of the S&P, express that as a percent. Right now, as of last Friday's close, it was at 61.8%. Okay. Dividing. Now, that's not the end of the month, though, because each of these are end of month except that last reading, which is not. That's intra-month. 3 trading days left after we do this interview. Uh, Back in 2011, we all know gold peaked in price and dropped hard. And during that process, it really started to collapse in the year 2013 and dropped to a final price low. And again, not this chart, this is a spread chart. Gold made its price low in December of 2015. And that's when that spread dropped down first time to near 50%. Okay, you can see there, December 2015. But
Hmm.
it had already come down hard. Okay, they had a nice rally after that bear low in gold. In fact, we turned bullish on gold at that point. Gold was 1,050 at that low. We turned bullish at 1140. But anyway, at that point, gold rallied sharply, but also rallied versus the S&P, and therefore you see that shot up to the green line from that low just above 50. You shot up just below 65. Okay, in that first surge. Okay, but actually there'd been a high prior to that on the spread that shows up as well. But anyway, you came down again in performance. Gold underperformed the stock market down to a low in 2018. Rallied again hard in price and against the S&P and shot up there just above 60% in 2020. We all recall the 2020 surge in gold because it had increased 40% in price from early 2020 to mid 2020. Gold went from like 1,400 over 2,000 or something. Anyway, and the spread also rallied. Okay. Then it failed again there, found resistance, sold off again relative to the S&P and also in net price. Gold pulled back then and made a low under the 40% level. Okay. And then you based for a couple years. And that was that period of time, if you recall, on gold net price charts, where it went sideways. It kept going up to 2000 and get bashed. Its low was like 16, 13 in that couple year period. So about a 20% pullback at extreme. But it went sideways, and the spread went sideways as well from 2021, 22, 23, 24. In March of 24, we put out a report arguing gold's about to wake up out of its 3+ year doldrums. And sure enough, the spread also exploded. And where did it go? It went up to the line in April where it hit the green line again. Now that green line is very important because it's recurring too many times as a pivotal point of resistance. 4 times you've hit that line, counting last April's high, which was just below 60%. And after the April high in gold, that's when gold reached 3,500, by the way. Gold pulled back for 4 or 5 months and went sideways net price, in a 5-month range, and the performance pulled back. So you get the pullback from that line of resistance. You've now emerged above an 11-year base top, clearly defined by 4 pivotal highs. Nobody's looking at this chart. They're all just looking at, oh, gold's 4,000 plus. That's a huge move, which it isn't. I'll explain in a second. You close here, you got a breakout. Now, what does this mean? Well, if you'll notice, every time this thing rallied, the spread up to that green line, that was also gold rallying in price, okay? Including the recent move from 2024 to the present, gold exploded in price, and so did the spread. You're just now breaking out freshly of a massive decade-plus structure. If this were a price chart, some little company that produces a product and it had a base like this, and you saw that breakout, any technician would say, I got to buy that guy. Okay. Well, what this spread chart is saying, there's about to become a massive shift in asset performance and preference into monetary metals and out of the S&P. This breakout signals that the arm wrestling match that we've seen for the last decade, up and down, really basically sideways, either side of 50%, okay, is saying, I've just broken out. This is something starting, not ending. So what I suspect is going to happen following this breakout, this technical signal, is that more money flow can rush into the monetary metals, which it's already been doing, as evidenced by the breakout, and outflow coming from the stock market. This just begins it. So in effect, if you flip this chart upside down and did it the other way, divide the S&P into gold, you'd see a topping pattern breaking through a support line. So either way, it says big asset change out of stocks, out of the paper bubble, into monetary metals. This is the chart that I think is the most important one right now for any investor.
If you found this video valuable, hit the like button, subscribe for more expert gold and silver insights, and share your thoughts in the comments.